good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. Today, we've got a North America-centric edition. Our European colleagues are on vacations, these kinds of things. So in the New York City metro area, we've got Fernando Valley joining in, and at 7:31 Lexington Ave, our global headquarters, we've got Scott Levine joining us today. So we'll do a quick check-in on commodities before we talk about earnings and other energy news that's been floating around out there. Oil is at $84 a barrel and change, Brent crude right now. Natural gas is, at least in Europe, is floating with 26 euros a megawatt hour. Henry Hub is quite a bit lower, sub $2 today. European carbon is at 56 euros a ton. So I think we'll table some broader commodity discussion and just hop right into the earnings cycle for everyone who is listening. If you don't know, BI covers about 2,000 companies globally. After every earnings reporting cycle, we go in and write our reaction to what we've heard, talk about what's next, and update all of the primers that we have written on all the companies we cover. And so, Scott, we haven't had you on in just a little while, so I think some of your offshore and onshore drillers have reported recently or are in the midst of doing so. So give us a sense. What are you hearing from the drilling names?
Yeah, thanks, Rob. So we had a big week for offshore drilling earnings last week. They're kind of late in the cycle to report. We also had Patterson UTI, which is a big, it's the number 2 land driller and pressure pumper. So starting with the offshore drillers, the earnings were, I'd say, mixed at best. It was a little bit of a weak earnings season for the group in general. Valaris was probably the strongest performer. I think they, certainly they were the weakest performer last year, and their distinguishing characteristic is more exposure to shallow water drilling, whereas Rig and Noble are exclusively focused on the floater market. And so, they are seeing more of an earnings uplift due to some of the rig reactivation that they've had recently. They also have good leverage to Saudi Arabia, and one of the big question marks for the group has really been Saudi Aramco's plans, ever since they announced plans to shelve 1 million barrels of additional capacity that they plan to bring on board. Valaris's take was really that shouldn't impact their 2024 outlook, and could certainly do so by 25 and 26. It seems like the cutbacks are going to be into oil fields, Safaniya and Manifa, and suggest that we're looking maybe a more modest intermediate term outlook for shallow water drilling in the Middle East. But this year the outlook, seems fine there. With regard to the other 2 guys, Transocean and Noble, the guidance was a bit more disappointing, as were the earnings. And there, I think there was a lot of enthusiasm for an upturn in deepwater drilling in particular. And the reality is that the pace of contract signings has slowed. I don't think there's any less enthusiasm regarding the outlook for day rates, still looking in the mid to high $400,000 range there, and optimism mostly in Brazil and West Africa. But it seems like the pace at which the market is accelerating has slowed, and that's creating some disappointment in the market pace. I don't think any less conviction that the recovery is on track, but maybe a little bit more that this there's this air pocket, and that it might extend till maybe the middle of this year before things start to pick back up again, assuming the story remains intact, which I think it will. So, maybe I'll leave it there. But those are the big three guys. Diamond Offshore report this morning. I haven't had a chance to look at them yet, but they're considerably smaller.
Okay, thanks for that update, Scott. Fernando, let's swing over to you. I'm curious if you have any reaction on that because obviously some of your companies might be doing some of the capex that affects Scott's names, and so just want to get your reaction to what he said, and we'll come around to some pretty exciting news about a couple of your names here in a moment too.
Sure. I think, two factors. First, the Saudi Arabia, we've talked about this before and how they're trying to replace some of their crude burn with solar and how that would not necessarily affect their ability to export more crude because if they are able to replace up to 1 million barrels a day, again, that may take longer than planned, but that is the long-term goal. Their exports could actually rise and offset the lack of growth that they plan for now. So that's one takeaway from the Scott's comments on Valaris. And then on Brazil, I think there's a broader issue there that we're starting to see a peak on the 2P field, which was the first large pre-salt field. It's starting to decline. And Petrobras has really two large growth fields, which are Búzios and Mero. And those fields are pretty much the bulk, especially Búzios, the bulk of the additions over the next few years. But beyond that, they don't really have significant growth. And when you look at the latest investment plan that they've laid out, they want to invest in refineries, which has been a disaster in Brazil, and they want to invest in offshore wind, which has been a disaster everywhere, as Rob loves hearing me say. So, there's a real question as to what's next. And that brings a broader question globally, because if Saudi Arabia is not, it's tabling 1 million barrels a day of growth, and Brazil may be below what was expected over the next decade, where will we see that supply growth? And to me, it's really not clear. Outside of Guyana, which has its own limitations, where can we see additional growth?
Thanks, Fernando. The UK may be one of the rare exceptions where offshore wind has been relatively successful, and we can talk about maybe why that's the case some other time. But first, I want to get your reaction on what's going on with the Exxon, Chevron, and Hess. If you run top NRG on the terminal, you can see a number of stories about that. But Fernando, tell us what's going on and what do you make of the interplay between these three companies right now?
Yeah, absolutely. There are also reacts by both me on Exxon and Chevron and Vince on Hess. So you can check those out for a little bit more of our views. But overall, we aren't privy to the joint operating agreement between Hess, Chevron, Hess, Exxon, and CNOOC to know exactly what makes it what's possible under that contract. Typically, corporate takeovers are not covered under preemption rights, but I'll caveat that to say that in the recent deal where Suncor acquired TotalEnergies' Canadian subsidiary, which is technically a corporate takeover, Conoco was able to exercise preemptive rights on the Surmont mine, where they were a 50-50 joint venture with Total. And they acquired that asset from Total, which led Suncor and Total to renegotiate. There was only one other asset in that joint venture, which was Port Hills, where Suncor is already the operator. And there were some tax loss carry forwards as well that they acquired. I'll say that was a specific situation. And then in the actual release, when Suncor announced its acquisition of TotalEnergies Canada, they mentioned that Conoco could activate preemptive rights. So there was a known factor there where there was a change of control provision in that joint operating agreement. Chevron and Hess did not, and what I've heard is that people who have spoken to Hess say they're fairly confident that Exxon and CNOOC will not be able to preempt in Guyana. But clearly that deal is being done for Guyana, and if there is no Guyana in that deal, there probably isn't a deal to be had, and the valuation for the rest of Hess's portfolio becomes much more challenged.
Okay, thank you, Fernando. Very, very interesting. And I'll reiterate what you noted at the beginning here is that one of the very interesting things about BI is we try to respond to market moving information and we put out reacts. For everyone who's on the call, we'll follow up afterwards and I'll send the links out for Fernando's reacts just so you can read them and see what he has to say. Scott, let's swing back around to you. What's your sense in general on the M&A consolidation type trends we're seeing in the oil patch? Is this a headwind for your companies? Yeah, I know it sounds like you've got a pretty optimistic outlook, kind of when you look out over the next 6-18 months. But what do you make of these kinds of things? Is there read across into your names?
Yeah, no, I think there is, and I think it's probably bearish, generally speaking, right? Ever since we've seen this recent wave of M&A with Chevron Hess and Exxon Pioneer announcements, right? There's two ways to view that. You can view, particularly from the perspective of the shale-focused service providers, the land drillers and the pressure pumpers, for the most part, are focused on the U.S. And so the upshot is that the majors are committed to the shale patch, and that supports expectations of continued growth potentially, albeit modest, and that's a good thing. The downside is the synergies, the additional pricing power that accrues to the customer side of the equation, right? And that they can press the service providers for price concessions to maintain the business. Another knock-on effect of the situation with Chevron and Hess. So Noble has a contract with Exxon and Guyana. And so whenever you see like these mergers, you see disruption in the customer base, and right, there's always gonna be winners and losers in that scenario, but generally speaking, the disruption can be viewed as a negative rather than a positive. So I think all in, the consolidation that we're seeing or have seen is probably negative for the group overall. I think you have to take things within context. And I think like last year, for example, clearly we saw the 20% decline in the rig count overall. Earnings grew across the shale service landscape, drillers and pressure pumpers. That was more a function of pricing discipline and more of the rigs and frac crews, kind of like legacy contracts, lower price contracts rolling over to newer, higher price contracts, right? And so that process is done now. And so if we're looking at a flat activity landscape this year, which is what folks were guiding to by and large in the U.S., I wouldn't expect to see that kind of margin lift that we saw last year from the either the drillers or the pumpers, and so I think it's probably flat. And this suggests we might see a little bit more pricing pressure accrue across the group, which would have a negative impact on pricing. And I think we're starting to see that factored into consensus expectations for the group. So all in, I'd say consolidation is worse for the servicers than it is positive. There's always a silver lining, in every data point. Everybody's trying to, as long as going to argue that, but I don't think there's any way you could suggest that that consolidation is good for my group now.
I want to ask a bigger picture, kind of medium term, longer term question that I think both of you can provide some insight on, particularly since we've been talking about offshore a fair amount here today. What's the sweet spot, or what's the marginal cost of bringing on some of these offshore projects? There was a time when I think some estimates would have said offshore needed over $100 a barrel, particularly in some of the offshore Brazil. So, Scott, we'll come to you first, but what's your sense? Where does the oil price need to be to have the kind of offshore drilling activity occur that you're talking about?
I mean, I think the long-term threshold is now $50 or thereabouts, generally speaking. So it's a lot lower than that. And when you get to $60, then people get nervous about $50 and the stocks start to reflect that, right? But I think that, most of the projects are economic at that level, and Fernando can talk about that a little bit more, but that's certainly what my guys are saying. And the long-term curve is certainly well above that level. I think and that's probably the case in most basins, and that factors in day rates, I guess at $500,000, which is where folks think it's going to for ultra deep water drilling. And so I think that's part of the reason I think folks are still quite confident in the sustainability of the recovery in offshore drilling. Although again, there's some weakness and some disappointment with regard to recent contracting activity levels but I think that that's kind of viewed as more a bump in a road that's still going up, so long as the commodity price deck holds, and we're still seeing it holding, and we're not really at a point where we're concerned about that yet. But I think $50, generally speaking, with some various puts and takes regionally, is still kind of viewed as the threshold to support offshore drilling recovery, and we're still pretty comfortable there.
Fernando?
Yeah, I tend to agree with Scott. It really depends on region the government take. If you're in the core of the pre-salt, that number is probably $30. Same with Guyana, maybe even a little lower, depending on where it is in Brazil. But then as you go further out in Brazil, for example, the new frontiers, like Sergipe, Alagoas, that's probably closer to 50. The equatorial margin, which still needs a lot of development, that's probably closer to 60. And the Gulf of Mexico, even, you have tie-ins that are closer to 55, but then the newer, if you're doing a brand new field that doesn't have an adjacent production platform and an adjacent natural gas pipeline, you're probably, around the 70s, if not 80s. Similarly, in West Africa, the government take tends to be so onerous that it's usually north of 70, if not close to 90, depending on the location. The bigger issue is, curious as to how Scott's companies and Scott feels about this, is there aren't a lot of discovered resources past what's already being developed. And so I think in order to see those day rates, you kind of need to get exploration going. And exploration is never as sexy as development because you're drilling 3 wells in an exploration campaign as opposed to 8 to 12 wells on development. But you can only really get into development into that mode once there's enough drive to get rigs out there to explore. So the question becomes, do we have a sustainable oil market above 80 where it makes sense for companies to venture out in exploration? And then a joint question to that is, if we are above 80, will OPEC and or US Shale just grow indefinitely? And I think the answer to the second question is no, regardless. I think we're coming to a limitation there. And so we expect to see exploration return in the second half of this decade. If it's 2026 or 2028, hard to tell right now, but we expect to see exploration back, and then that will give you the tailwinds that I think Scott was talking about, getting day rates closer to 500.
Very interesting. Go ahead, Scott.
Yeah, no, I was going to say that certainly sounds like it makes sense, and certainly there are some frontier markets where we are hearing some rumblings of exploration interest, whether it's in the Eastern Mediterranean or some of the other markets within South America. But as you mentioned, it's kind of a slow start with a few wells here and there exploration wise, and you need to see follow through, and so we're still far away from that. But we still haven't hit the $500,000 threshold, and I would say a year ago, investors and operators were probably expecting we would have been there by now.
Fernando, I'm curious about your views later this decade. Does this suggest that the role that US shale has played in balancing the oil market will be more diminished when you look out, say, 5 to 10 years, and that some of these offshore, wherever the jurisdiction is, projects could be much more meaningful in terms of helping meet overall supply needs when you look out 5 to 10 years?
Yeah, I believe so. I think as we go into consolidation and we focus more and more on the Permian, it will slow down the pace of growth. And remember, there's a very fast decline that needs to be refilled with US shale. So I think part of what happens here is while the majors that we've talked about, the five largest companies in shale now, Exxon, Chevron, Conoco, Occidental, and now Diamondback, with the proposed Endeavor deal, they'll control over 50% of the Permian by 2027. So will their growth essentially be offsetting most of the decline in other regions of the country, most of the decline on private operators, or will actually everyone be growing at the same pace? It seems hard to me to believe the Bakken will go past its peaks. Even the Eagle Ford, I think, probably has reached its peak or is very close to it. So we're really banking on the Permian, and I think the hopes that we would eventually get to 16, 17 million barrels a day as a country have faded significantly. I think there's maybe we'll be able to get to 15 million barrels a day if oil prices cooperate and Scott's companies cooperate. But even that is not a given. And so when we see decline in other parts, and I've mentioned, Brazil stabilizing, Mexico we've talked about before that's declining. We have other areas like China and the UK, North Sea declining. You have to offset those declines with new production. I think the US can help you offset some of that decline, but it's no longer the engine of growth that it was over the past decade.
Very interesting. Well, let's swing back around to the general commodity price environment. We're at mid 80s on Brent today, basically flirting with the highest price of the year intraday. Started out the year kind of mid 70s. So, what's going on, Fernando, with the oil market at the moment? It sounds like there's been a lot of concerns about demand, interest rates, all these other factors. But are geopolitical risks creeping in, driving the market narrative right now? What's your sense on why we're seeing the uptick?
I think to me, it's really about China and a perceived recovery there, really driven by the Lunar New Year that's driving demand up, and that's been a positive there. If you see just the momentum in China, it has been fairly positive over the past couple of weeks, and I think that's driving oil prices. When you look at demand itself, I don't know that you're necessarily seeing a significant uptick. There's some led by weather-related impacts, but overall, the chances of a rate cut in March are now zero, that at least priced in. The pricing in for a June rate cut is now to 50-50. So those aren't really bullish signs for demand. And then as far as the refining and crude side of the equation, we've had a lot of refinery outages over the past couple of weeks, some of it planned, some of it unplanned, like the BP Whiting refinery, that are affecting the supply of fuels and raising crack spreads. I think some of that, because of the CTAs, has led to more bullishness on crude. But we think that is just a temporary effect that will normalize over the next couple of weeks. On the demand side of the equation, we haven't seen a commensurate increase that would make us more bullish on gasoline or diesel.
Scott, I know that I suppose your companies are really just price takers, but in terms of earnings commentary, you mentioned that it sounds like folks are quite comfortable with where we are in terms of pricing. But do you get a sense? What are they concerned about? Any of the factors that Fernando mentioned affecting the overall commodity price environment?
No, I wouldn't say that they're concerned about that. I mean, the concern is probably more on the gas side, right? We've had Henry Hub has broken well below $2 a barrel here, or 2 per MMBtu, sorry, and it's almost like it's like it was a year ago, in that the concern is on the gas side. And if a year ago, obviously natural gas prices were at much more elevated levels going into the winter than they were here. I think the highest they got was probably in the low to mid threes. But still, certainly this year, again, has been a disappointment for gas bulls, and the concerns now are really more that we've got weakness in gas drilling. We haven't seen evidence of that yet in the rig counts, but certainly we've heard it in the commentary from our companies. But from an oil drilling perspective, no, I think there's still, a high degree of confidence in the outlook. And again, that's a flat outlook. Our guys have been way too, as is normally the case, aggressive in terms of the outlook for the rig count throughout the last 18 months. Our management teams, that is. And so, this year, 4Q earnings season, I think the outlook is basically flat for drilling, with some downside bias due to gas, and gas accounts for maybe 20% of the total U.S. rig count. And so, no, I think there's confidence on the oil side, to the extent some of those factors Fernando laid out play out. That's the reason for additional concern, I suppose. We'll see where it goes from here. But I think where there's more concern, it's on the gas side, as was the case a year ago. And some of the news regarding LNG exports and the Biden administration, hitting the pause button there. There was some cold water on that story, because the hope was that increased export demand would drive an uptick in gas drilling maybe a year from now or so. And while fundamentally, hitting the pause on permits doesn't fundamentally affect that, the optics are not good. Let's just say that, as far as what the administration did with pausing the permit approval process there. So I think that's probably the situation overall. But for oil, I think there's still a fair degree of optimism amongst the drilling community.
I'll just weigh in on your comment on gas too. I mean, look, at the end of the day, renewable developers are probably cheerleading for higher gas prices too. It's very hard for a wind or solar project to compete with sub $2 gas. Now, when you zoom around the world, the U.S. gas experience is quite different than where we see gas prices at globally. I mean, Europe's over $8 per MMBTU equivalent right now, and much easier to make the economics of a renewable project work in that context. I would just quickly add, from my franchise, we've had a few reacts out as well. Particularly yesterday, we had earnings from First Solar. If you don't know them, they're kind of the national champion of solar module producers in the U.S. And 45% gross margin business, strong top line growth. So, even if solar doesn't make sense in pure isolation, as maybe Fernando might point out, it gets a lot of support from the government, and that's really helping to propel not just their margin story, but their growth story. So please do check that out. And I think we've reached the end of our time here, so we'll make this our stopping point. I would encourage you, if you've got any colleagues that are interested in energy markets, please spread the word. We want to have as many of you join these conversations as possible. We'll do the next one on Wednesday, March 6th at the same time. And as always, feel free to ping any one of us if you have follow-up questions or you want to suggest topics that we discuss here on the call or research ideas that you want to see us work on. So take care, everyone. I hope you have a great rest of your week.